So now we will consider the hedging methods available for forex risk. So foreign currency risk management is what we are going to deal now. So there are like several methods here. So one is called as the internal hedging methods and the other one is called as external hedging methods. So we'll discuss each of these methods in detail. So we'll start from the internal hedging methods. So the first one is, if you're going to enter into a forex transaction with another party, the best option for you is to not do anything. So what happens is, you're not going to take any hedging mechanisms to protect you from the forex risk. That is, you accept the forex risk. So why do you do that? Because you feel that in the long run, what would happen is, sometimes you will get a forex gain, but sometimes you'll have a forex loss. Both will be like compensating each other. So doing nothing, do nothing is a better option. They feel this is because this method works for small occasional transactions and it saves in the transaction cost. Okay, so you don't need to. So when the gains and losses are going to nullify each other, then you are only going to waste transaction cost in trying to hedge your forex risk. So the second one is to deal in your currency. For example, you sell a good and your parity works like this. You're selling a good for $1, okay, to a foreign company, and you feel that you will get 70 rupees. And after a month, when the foreign company gives you $1, the rupee is at 60. So what happens is, when you price in their terms only, the problem arises. Better what you can do is, you can ask the foreign customer to pay you in your currency. So what happens is, uh, if he has to pay you 70 rupees, irrespective of whatever is going to be the currency parity, he will always pay you 70 rupees. So does it mean that the forex risk is like gone away? The answer is no. The forex risk is still there, but you have shifted the forex risk from yourself to the foreign company. So, but can you work out this in all the cases? No. The answer is, you have to be, your company has to be, and your products has to be in such a strong position that the other party is willing to accept the forex risk. Insist all customers pay in your own home currency and for all imports in home currency. This method transfers risk to the other party but may not be commercially acceptable in the long run. So only when your product and your services are so strong that the other party will be willing to pay in your home currency. The next one is called as lagging. So lagged payments, delaying payments beyond their due date for goods purchased in a foreign currency. For example, what happens is, assume that you have to pay $1 and the rate today is 80. You feel that if you can delay it for another month, the rate might become favorable to you and you only have to pay 70 rupees and get the dollar and pay it to the foreign company. So what happens here is, you are trying to delay the payment, but this is not such an acceptable method because the foreign company might not accept beyond a date, okay, or they'll levy you a fine on you, or they will not try to see you as a good customer. So what happens is, in the long run, they might have a bad reputation about you. So lagging is acceptable within the payment terms. There's something called as a leading. So leading refers like this. Assume that you're going to receive a payment from a foreign customer. So from a foreign customer, you are going to receive a payment. Currently, it is 70 rupees, but you feel that it might go to 60 rupees in the future. So what you do is, you are trying to make them pay now itself. Okay, so you're asking for the income to be paid now itself. Okay, so you can give some kind of a small discount or some kind of a benefit for the customer and try to get the dollar as quickly as possible. So this can also be done in terms of a payment. For example, the current dollar price is like $1 to 70 rupees, and you feel that it might move against you in another 2 months time. but the customer has given you 2 months time to make the payment. But what you do is you try to pay it as soon as possible and try to lock the exchange rate at 70 rupees. So even though he has given you 2 months time, you feel that the price might go to 80. So you feel that it's better to make a payment now itself at 70 rupees for a dollar. So that is called as leading payments. So when a company has receipts and payments in the same foreign currency due at the same time, it can simply match them against each other. It is only necessary to deal on the forex markets for the unmatched portion of the total transaction. We will see an example for this. So assume that you are an Indian company and you have bought $400 of worth of goods from XYZ and you have to pay it in 3 months time. At the same time, you have also sold goods worth of 1,000 to another company called as ABC Co. and you are going to receive that amount in 3 months time. So what happens is at one point of time there's an outflow in 3 months and one point of time you have an inflow of $1,000. So how much of amount should you hedge? The hedging amount will be only 600. Okay, so this minus 400 and the plus 1,000 would have to be net off against each other. So you are ending up with $600. Okay, so this alone has to be hedged. So the next method is called as netting. Netting is similar to the matching concept which we saw earlier. Netting is the process in which credit balances are netted off against debit balances so that only the reduced net amounts remain due to be paid by the actual currency flows. Many MNC companies engage in intra-group trading where related companies located in different countries trade with one another. There is likely to be intercompany indebtedness denominated in different currencies. Similar to matching concept, what happens here is there might be several subsidiaries. For example, Nestle company might have a US subsidiary, a UK subsidiary, uh, Indian subsidiary. Okay, they might have like several subsidiaries. So all these several subsidiaries will be like trading against each other. For example, the Indian subsidiary has to pay $1,000 and the US subsidiary has to pay $600 as outflow. Okay, and for the UK subsidiary has to pay the US subsidiary around some $2,000 and the US subsidiary has to pay around some $1,000. Okay, so what we do here is we try to net it out. So if we net out this position, what happens is there is only like $400 that are like have to be hedged. That is an income of US. Okay, income in dollar terms for US. If you hedge out, if you net out this position, what happens is there is a $1,000 inflow for the company. So there is a two types of inflows for the company. So the company has to hedge for a total position of $1,400 because it is getting an income of net dollars from India as 400 and then again a net dollar of 1,000 from the UK. So the total external hedging required, would be for the $1,400. So that's about netting. So the next method is called as foreign currency bank accounts, where a firm has regular receipts and payments in the same currency. It may choose to operate a foreign currency bank account. This operates as a permanent matching process. The exposure to exchange risk is limited to the net balance on this account. So assume that a company has a regular inflow and outflow of receipts. So what it can do is it can create a foreign currency account in that foreign country, and for the balance of the net amount alone has to be hedged. For example, a Indian company has a US account. Okay, US account. The US account is going to get $600 as inflow, and it also has to pay around some $400 as expense. So this is their expense and this is their income. So how much should be hedged? The hedging should be only for the $200 because the income is going to be paid as a dollar expense. So the balance of $200 alone has to be hedged. Okay, so that is what about foreign currency bank accounts are. So the next one is matching assets and liabilities. So we'll have an example. Assume that there's an Indian company. This Indian company wants to open a factory in US. So they open a factory in US. This factory is going to sell goods to US people, and US people are going to give the dollars or income to the factory at US. Okay, so the company is going to get a lot of dollars, and this dollar is going to be like transferred to the Indian company. Okay, and the Indian company has actually got it as a loan. The amount to construct a factory is got as a loan, and for that loan interest they are going to pay this amount. But the problem is this loan interest is going to be paid in rupee terms. So what happens here is the dollar income is converted into Indian rupee and then paid the interest. So when you convert, there's a conversion problem. So there is a forex risk. So how can you overcome this part? To overcome this part, we can simply do this mechanism. The Indian company can get a loan at US itself. With that loan, they can build the factory. Okay, so what happens is the interest that has to be paid for this loan is in dollars. So if the company is going to sell goods, it might get $100. With that $100, they're going to pay an interest of something like $60. The balance $40 alone would be like converted into rupee, and that will go to the Indian company. So rather than having a $100 of forex fluctuation, now the company has to deal with $40 of forex fluctuation. So this is a better method than the earlier method of borrowing in India and investing in US. Now they have borrowed in US and invested in US, and they also selling in US, and they also pay the interest in US. The residual amount alone comes to India. So a company which expects to receive significant amount of income in a foreign currency for a few years henceforth would like to protect foreign currency risk. Hence, will create an obligation which is paid in the same foreign currency to be received. The foreign currency obligation can be a overdraft, payable, long-term loan. So that's what happens here. So this is the US factory that we have spoken, and this is the US loan. So this point refers to US factory, the dollars that we are going to expect over a future period, and this is the obligation which he tells in the foreign country. So that's about the matching assets and liabilities. It can also be called as asset liability management in forex. So the next one is called as forward contracts. Under the terms of a currency forward contract, one party agrees to exchange a certain amount of one currency for a certain amount of another currency at a future date. This type of forward contract in practice will specify an exchange rate at which one party can buy a fixed amount of currency underlying the contract. So we'll have an example like this. Assume that you are an Indian company. Okay, you are expecting to receive $100 from a US company. Okay, today the rate is 60 rupees, but the US company is going to pay in 3 months time. At that time you feel the rate can move to 40 rupees, okay, which is against you. So if they give you $100, it would be like 6,000, but you feel that if they give $100 in 3 months time, you will get only 40. So what you do is you enter into a forward rate. Okay, you will enter into a forward. So what you do is you go to a bank and say that you want to enter into a forward contract. The bank, what they do is they say, in 3 months time, if you give us $100, if you give us $100, for each dollar we will give you, irrespective of what is the price in the current market, we will pay you at least 55 rupees. We will pay you 55 Indian rupee. So what happens here is, as promised, the US company will give you $100, and with that $100 you won't go to the spot market. Okay, irrespective of going to the spot market, you have to go to the bank. As promised, you have to give the bank $100, and the bank will give you 5,500 rupee for the $100 that they have promised you. Okay, so irrespective of whatever happens, you will receive the 5,500 Indian rupee. But the concept works in two ways. In the 3 month time, what happens is we have two scenarios. Scenario 1, and we'll have a scenario 2. Okay, in scenario 1, the actual market rate has been something like 60 rupees. Okay, in another scenario, the market rate, okay, in the 3 month time is around 50 rupees. So now what happens here is, you have got $100. As promised, the bank has given you 55 rupees. But how much would you have got if you have not gone for the forward contract? You would have got 60 rupees. Now, have you lost your money? The answer is yes. Because without the forward contract, you could have given the $100 at 60 rupees now, but you have already promised them at 55, so you have to give them. So what happens is, effectively you lose around 500. So this 500 is a loss for you. But we'll think in terms of the other way. Assume the rate is not 60 but 50. In that terms, what happens is, the bank has promised to give you 55, that they will give, but the spot rate in the market is only 50. So now what would happen is, if you convert in the current market, you will get only 50 rupees, but bank has promised to give you 55. So now you will effectively earn $5 rupees per dollar additionally. So you will get around a gain of 500 rupees. Okay, so that's how it works. You can also work out this in a different manner. So how much did the bank give? The bank gave you 5,500. In the CIS scenario also, it's 5,500 minus and minus. If you have converted the $100 at 60, you would have got $6,000. Here, $100 into 50 would have got you $5,000. So have you made a profit? If you could have sold at 6,000, but you have already sold it at 5,500, so you are effectively getting a minus 500 of loss. Here in this situation, if you sell it on the spot market, you will get only 5,000, but if you give to the bank, you will get 5,500. You have arrived at a gain of 500. So these are the ways in which you can work out a forward. But a forward contract is a compulsory contract. You cannot like cancel it in midway. So that is a problem with a forward contract. So we'll move on to the next topic. It's called as money market hedging. Money market hedging involves borrowing in one currency, converting the money borrowed into another currency, and putting the money on deposit until the time at which the transaction is completed, hoping to take advantage of favorable interest rate movements. So rather than seeing it as a theoretical topic, okay, we'll look at it from a step-by-step manner so that we'll get an idea. So ABC Co is an Indian company and has sold goods to US for $1. So today the price of the $1 is equal to rupees 75. XYZ says that they will make the payment in 3 months time. In 3 months time, they have made the payment. XYZ Co has made the payment and the Indian company has received the $1. We'll have two scenarios now. In case If ABC, when they are getting the $1 after 3 months, okay, when they go to conversion, it is only 60 rupees. So what happens is, the contract was entered, they thought they will get 75 rupees per dollar, but now what happens is they got only 60 rupees. So that is an effective loss of 15 rupees. That is an effective loss of 15. In another scenario, if you take, assume that the Indian company has $1 and they have gone for conversion. When they go for conversion, they thought they will get 75 rupees, but they got 15 rupees. So that is a gain of 15 rupees. So there's a problem here. The company has to take a hedging because they don't know like which side the currency rate will move. So it's always better to take a hedging. So we'll see like how money market hedge works. So we'll look at the money market hedge from the expenses angle. So we'll follow a step-by-step example. So the Indian company has to pay around $1 to a foreign company, and to pay that today they have to, the conversion rate is 75 rupees. So they go to an Indian bank and they borrow 75 rupees, and the payment has to be made in 3 months. So what they do is they first borrow this amount and then they convert it today itself at 75 rupees to a dollar. And rather than paying the company in US, the client, they what they do is they deposit in US, okay, in a US bank for 3 months the $1. After 3 months time, what would happen is we will close the deposit in US, okay, and we'll pay this $1 to the US company. So they will close the loan in the Indian country at 75 rupees because that was the amount that they have borrowed. So this is what the money market hedging for expenses side. We'll now look at the money market from the income angle. So assume that the Indian company has to receive $1, okay, from the US company. Let's see like how it happens. So either way, we are going to receive $1 from the US company in 3 months time. So what we do is we go to a US bank, we borrow for 3 months time, okay, the $1. That $1 is converted today itself at 75 rupees worth, and the Indian company has received that 75 rupees. This 75 rupees is deposited in an Indian bank for 3 months. After 3 months, what would happen is the American company pays $1. With that $1, we close the loan that we have taken in the US country, and we will also close the loan, we'll also close the deposit that we have made in the Indian country, and we'll get the 75. Okay, so effectively what we are doing here is, rather than waiting for 3 months to receive that $1, we have got a loan from the US country, took the dollar to India, we've deposited in an Indian bank. Once the $1 has been received, we take that $1, rather than converting it into Indian currency, that $1 is used to repay the foreign country bank, okay, US bank. And in our country, India, we have already a fixed deposit account for 3 months. We close that and we get the 75 rupees back. So we are effectively, this entire mechanism, what it does is it skips the currency conversion in the 3 months time. So that is what it is effectively doing. Whether it's going to be income or whether it's going to be expense, the mechanism is like very similar, but you have to understand it properly, because based on this understanding only you will have theory questions as well as numerical questions. So now we'll move on to the next one. It's called as a derivative market. A derivative is a security with a price that is dependent upon or derived from one or more underlying asset. So a derivative is not an asset, it is only a contract. The value of the derivative is actually depends upon the value of the underlying asset. Derivative itself is a contract between two or more parties based upon the asset or assets. Its value is determined by fluctuation in the underlying asset. Common underlying assets for derivatives market includes stock, bond, commodities, currencies, interest rate, and market indexes. Derivative either can be an over the counter instrument or an exchange traded instrument. So over the counter traded instruments are like informal, like contracts on a basis of direct dealing. So over the counter instruments are like direct dealing, where one company has to approach a broker and the broker approaches another company. So there is only an intermediate between the two companies here, and the contract is only between the two companies directly. But in an exchange, the buyer will not know the seller directly and all. So the exchange will sit in the middle between the buyer and the seller. Okay, and there's no risk at all when you are going to trade with an exchange. Okay, so you can be like 100% safe that the other party will honor its commitment. That cannot be said to be true in terms of the over the counter trade, because the other party can default on its promise. OTC derivatives constitute the greater proportion of derivatives in existence and are unregulated, whereas derivatives traded on exchanges are standardized. So it is always better to go with exchange traded instruments. OTC derivatives have greater risk for the counterparty than do standardized derivatives. So OTC derivatives will always have counterparty risk, and standardized derivatives like exchange traded derivatives will not have counterparty risk. So now we will discuss about the futures. Currency futures are standardized contracts for the sale or purchase at a set future date of a set quantity of currency. So currencies are exchange traded instruments. Currency futures can be used to hedge currency risk in the same way as forward risk. So there's no difference between a forward risk and a future risk, except for future is a standardized exchange traded contract. Forward is a direct contract between two parties. Futures are exchange traded, whereas forward contracts are over the counter transactions. Forward contracts are used much more extensively than currency futures. Advantages of futures: the transaction costs are lower, futures are tradable and can be bought and sold on the market, so there is a pricing transparency. Futures contract can be closed before the last date of the contract. Okay, so these are the advantages that future contract has when compared to the forward contract, because in forward contract the broker will charge a higher amount of transaction cost, and there is no exchange in which forward can be sold. Okay, so it is always like the pricing is not transparent in forwards, and also you cannot close a forward before the last date. Okay, only futures can be closed, forwards cannot be closed for the last date. So now we'll move on to options. A currency option is the right of an option holder to buy or sell a quantity of one currency in exchange for another at a specific exchange rate on or before a future expiry date. If a buyer exercises the option seller must sell or buy at this rate. If an option is not exercised, it is lapsed at the expiry date. In options, you have the right whether to exercise the option or to just leave the option. For example, you are going to receive $1 from a foreign country. Okay, you have entered into an option. The option works like this: you have the right, okay, you have bought a put option. Okay, you have bought a put option. Put option is the right to sell. You have the right to sell $1, okay, at rupees 70, okay, in 3 months time. On the third month, okay, the dollar and rupee parity is something like 60. So you have got $1 from the foreign country in 3 months. Now you also have an option contract. In this option contract, you have the right to sell the dollar at 70 rupees. Okay, but the current spot rate is only $1 to 60. Will you accept this option, put option or not? Yes, because if you're going to exercise your put option, you can easily sell that $1 at 70 rupees and easily make 70 rupees, because in the market if you sell it's only 60 rupees worth. So there is a 10 rupees differential. So you will go with exercising your put option. But the same case will change if the $1 in the 3 months time, the spot rate is something like 80 rupees. Okay, 80 rupees. So again the foreigner has given you $1, but now the spot rate is 80 rupees. Now you have the right to sell the dollar at 70 rupees. Okay, or you can sell it in the market at 80 rupees. Which one you will go? You won't go for the option, you will go for the spot rate. So you will leave the option to just expire. You won't exercise it, it will expire, and you'll use the spot market to sell your $1. So this is how the market works. But to get this option, you have to pay something called as an option premium. An option premium is the cost to buy this option. Okay, so we'll move on to the currency swap. We'll look at an example for this. We'll take two companies. One is a US company and the other one is an Indian company. So the US company gets a loan from the US bank. It gets a 10 million loan at 6% interest, and the Indian company gets 450 million at 7% interest from an Indian bank. But the problem is the US company wants 450 million rupees and the Indian company wants 10 million of dollars. So they want to exchange actually. So they try to exchange. So they exchange their country currencies. So the Indian company gives 450 million rupee to US company, and the US company gives the USD 10 million amount to the Indian company. So the capital amount has been like swapped. Now we will move on to the interest rate swap. In the interest rate swap, what happens is the Indian company has to pay interest. So what interest they pay? For the 10 million that they got, okay, for the 10 million that they got, they have to pay the interest which the US company has to pay its bank. So 6% on the USD 10 million has to be paid by the Indian company to the US company. So the US company in turn, what they do is for the 450 million Indian rupee that they got, they pay the 7% interest rate, which is the Indian bank interest rate, will be paid to the Indian company. So once this has been paid, the US company pays the interest amount to the US bank, and the Indian company pays the interest to the Indian bank. So the interest have been paid. So that is about the local interest paid. So now again we will see the principal repaid. Assume the interest is like kept on swapped for around some 3 or 5 years. At the end of the contract, something like at the end of the 5th year, what happens is the principal again gets swapped. For example, so the Indian company gives away the USD 10 million and the US company gives the INR 450 million back to the Indian company. So now both the companies will repay their respective banks. So with this, the swap is over. But why did the companies actually enter into the swap contract? The swap contract is entered because each country's companies want the currency of the other country. They couldn't borrow it in the other country, so they try to find out a partner who's able to borrow on the other country. So that is the reason why they go for a swap. A currency swap is an agreement in which two parties exchange the principal amount of loan and the interest in one currency for the principal and the interest in another currency. So we'll have an example to understand this better. At the inception of the swap, equivalent principal amounts are exchanged at the spot rate. During the life of the swap, each party pays the interest on the swapped principal. At the end of the swap, the principal amounts are swapped back at either their prevailing spot rate or a pre-agreed rate, such as the rate of the original exchange of principal. Which of the following statement is correct? Once purchased, currency futures have a range of closeout dates. No, it's not about the range of closeout dates. It can be sold on any date possible. Okay, so any date before the expiry date, the currency future can be closed. So it is not about the range of date. It can be closed on any date. Currency swaps can be used to hedge forex risk over longer periods than the forward market. This is a correct option because currency swaps can be used for a period of 5 years also. But if you take a forward forward contract, it is usually for a 1 year period only. So it is all. So this one, option B, is correct. Banks will allow forward exchange contracts to lapse if they are not used by a company. No, forward contract cannot be lapsed, it has to be honored. So this is wrong. Currency option premiums are paid for when they are exercised. It's not when you exercise it. When you buy an option, you have to pay the premium. So this is wrong. So the option B is the right one. We'll move on to next. So we have another question. Which of the following hedging methods will not be suitable for hedging the euro receipt, that is a transaction risk? So which of the following was not used for a transaction risk? Forward exchange rate can be used for transaction risk. Money market hedge can be used for a transaction risk. Currency futures can be used for transaction risk. But currency swap is a longer term arrangement, so you cannot use it for a transaction risk. So he's asking which of the following is not suitable. So currency swap is not suitable for transaction risk. The answer is D. So we look at the past exam questions that have come. This this chapter seems to be a lot. This chapter seems to be like generating a lot of theory questions. So every exam attempt there has been questions from this chapter. So ensure that you thoroughly understand this chapter and questions. The questions can be asked in section A and B as 2 mark questions. Earlier the same was asked in a section C also, but now they won't ask you in section C. But in section A and B, you will definitely have questions from this chapter. So thank you very much for watching. We'll meet in the next video.